So I think it's Bitcoin first, then ETH, and when ETH goes, all of the tokens go up as well. So we're going to see some crazy times ahead. I'm still remain extremely positive. I've said all the way through, you're going to expect a 50% correction in the middle of this. We've had a 50%. Could it go to 60%? Is it finished here? Who knows? But it's going to take a while to digest, so it's not going to rally and go in a V shape. But in a few months, my guess, and I have no idea, my guess and all the work I've ever done on this is that we should be seeing higher prices for the rest of the year. So around this phase, buy the dip if you can. You know, if you're able to, again, don't use leverage, be cautious, understand what risks you're taking, but I think it's a great opportunity. So that's the general rule of thumb for that. El Salvador.
Queda aprobada la ley de Bitcoin.
Lawmakers in El Salvador broke into applause after voting to approve Bitcoin as legal tender on Wednesday, making the Central American country the first in the world to fully adopt the cryptocurrency.
The honest answer is, I don't know. I know everyone's got a hot take. Oh my God. The point being is, they're allowing it as, not as their main currency, but as another one. So you can use it, and they've said all businesses, etc., have to accept it. The issue is El Salvador is an interesting case because their currency is actually, their economy is dollarized, but they're not having currency volatility. They're not Argentina, right? So they're not looking for an escape from currency volatility, which people are confusing it with. So why are they doing it? Because their currency is not being devalued. So they're not living with an economic shock. A lot of it is remittances, of which the Strike network is great for remittance payments. So a lot of it's for that. And also gives them access to a saving product that has historically done very well. It's a 213% return a year over the last 12 years. But the flip side is it's incredibly volatile. So if you're a poor farmer and you've suddenly made what looks like $1,000 because you put your savings in Bitcoin and it's gone up 300%, and then your savings fall by 70% in the crypto winter, that's going to scare a lot of people. And if they're not used to currency volatility because they've got a currency board now, I'm not sure how good that is. I think it's interesting. I think people will figure out how to use it, what its use case is. The point being is everyone jumps to a conclusion. I'm not going to jump to a conclusion. I think at the margin, it's good for Bitcoin. Clearly, it's driving the narrative. Clearly, a bunch of other countries are looking at it. I've confirmed conversations on that front as well. Everybody's looking at this. People are trying to figure out how it works for them. And that's great. Is this the panacea? Is this the great, a nation moving into Bitcoin? No. But I tell you what was genius out of it is everybody's now started using volcanoes. Bitcoin is a volcano because when it came to, well, you should mine this for your reserves, now it gets interesting. Should an economy like El Salvador have Bitcoin in their reserves? Without question, they should. But how do they get it? Without spending other money from their reserves, and they probably don't have enough reserves. And the nice part is they figured out they can mine it because they got volcanoes, and those volcanoes have massive geothermal springs. So basically, free green electricity. And so now El Salvador, and pretty much anybody else with a volcano, with that kind of nice setup, can mine Bitcoin at a country level, generate a asset that they can put on their reserve balance sheet that will grow over time and protect them from the general devaluation of the US dollar in fiat money terms, the debasement effect. So at that level, brilliant. At remittance level, brilliant. Everything else, unproven. If you de-dollarized and adopted a 70-volt asset, you're going to utterly destroy your economy. Because nobody has the ability to forecast or hedge currency in that kind of market, and it's very expensive to do so. So we need to understand moneyness really in this equation. What works as money, what works as store of value, what works as a reserve asset, and don't confuse the whole lot because you are utterly going to destroy every industry in El Salvador if you can completely convert to a 70-volt currency. And the moment the currency goes to the roof, their costs change, collapse their costs change, imports go up, imports go down by such huge swings. I mean, that would literally hole out everybody. Back in the 90s, I started and managed the hedge fund sales business in equities and equity derivatives for Goldman Sachs. I then, in the early 2000s, went to GLG Partners, which is now Man Group, which was the largest hedge fund firm in Europe at the time, where I started and ran their global macro hedge fund. Then I moved to the Mediterranean coast of Spain, sort of semi-opted out of the rat race and started writing macroeconomic research for the world's biggest global macro funds, hedge funds, sovereign wealth funds, family offices, that kind of thing. My background's basically 30 years of global macro. Then I'd gone through the financial crisis in 2008, and I was one of the people who was kind of at the epicenter of predicting what was going on. A lot of people in the film The Big Short were kind of clients of mine. And I kind of knew a lot of how this might play out. The same happened in 2012 when Europe almost fell apart. So I was thinking, why me, living in a beach town in Spain? How come I've got all the access? And people in the street would come up to me and say, well, why didn't we know? And I thought, there's something wrong here with the distribution of information, that only some people get it and others didn't. And that's why I started Real Vision. So Real Vision's basically a video-on-demand platform. It's actually larger. It's now a broader media company that basically concentrates on helping other people gain access to the world's most preeminent intelligence, financial market intelligence. And we do that by interviewing the world's most famous hedge fund managers, independent analysts, strategists at length. Also in that journey, so I had a journey that I wanted to help educate, level the playing field, and understood that the world had changed away from the intermediaries to a disintermediated world, and I wanted to play a part of that, and video was the big answer. But in that journey, having gone through those two huge crises so close to each other, and having almost lost the banking system in Spain, I started a journey of trying to figure out, could I set up the world's safest bank? I know that's a slightly kind of crazy, arrogant thing to think, but I thought I'd give it a go. So we got together with a bunch of others, and we went around the world to Singapore and the Middle East and to Switzerland and the US trying to do this, and it became hard. And one of my clients at the time kind of tapped me on the shoulder and said, you should look at Bitcoin. Maybe this is your answer. So this was 2012. And so I learned about it. I invested in it for the first time. It went up 100% in a month. And I closed my position, took my money and went, wow, okay, this is not normal. And then I kind of did the first analysis of stock to flow, meaning I looked at it like gold and thought, well, with this much supply and this much gold above ground and this much known reserves, if we imputed the same thing for Bitcoin, when gold was at 1,300, Bitcoin should be at 1 million. I also realized that after 2012, the next global recession would see this parallel financial universe using blockchain technology meet this macro world of excessive debts, a financial system that's somewhat fragile, and all of these things would have a horizon point. And that all happened last year. So at top level, the internet grew at an adoption rate of 63% a year from 1999 to 2000. That was the fastest adoption of any technology the world had ever seen. So in its broadest sense, is actually growing at an adoption rate of 113%, twice the speed of the internet. So this is of an order of magnitude none of us have ever seen before. And most of our narratives are somewhat behind what's actually happening because so many people are working on this. But what I think is going to happen to the financial industry, I think it's actually going to change all global business models. But to the financial industry, we know some of the big problems outstanding. Things like rehypothecation. What happens at things like DTC level, CC level, or Euroclear? Who owns what asset? The ability to tokenize these assets is a game changer. And the ability to trade 24 hours a day instantaneously and fractionalize it is also a game changer. So I can't see any reason on earth, while all equities and all bonds are not going to go into the blockchain. We've also seen the rise of DeFi, and that's decentralized or somewhat centralized lending protocols and borrowing protocols that work algorithmically, seem to be pretty robust as far as we've tested, and that looks like that will scale as well. So what we're doing is we're creating a modern system of finance I spend a lot of my time speaking to these world's largest hedge funds. I present to a lot of asset management firms, the entire firm, all of their portfolio managers. And I've done that around the world for various people, helping them understand, the benefits of holding some of this stuff in portfolios, for example. And I see nothing but ongoing adoption. Regulation, people are waiting for more regulation, as Mohammed said, because some people need clarity. A lot of the hedge funds don't, but the institutional asset managers do. I see nothing but people thinking that it diversifies their portfolios and has great portfolio effects for them. They don't need to allocate a lot of money, and they don't need to make the decision that we're all thinking about. Is they just can make the small step. Most haven't made the small step yet. The hedge fund industry and the family office industry has. The asset management industry is only just starting. The first step will be Bitcoin, then probably Ethereum, and then it'll be an open conversation of, can we treat this like real-time mark-to-market VC, and can we bet on protocols, tokens, and ideas that may disrupt our whole industry, and so therefore we benefit from the disruption. I think many investors misunderstood what happened in the last 20 years with these big stocks that came out of the birth of the internet. Google, Facebook, Apple, and there's a whole bunch of them. I spent a long time trying to understand what that was. What really happened there? Why did we all misjudge it and say, well, it looks ridiculous. Amazon's worth more than every bookseller in the world. This doesn't make sense to me. And so many of us missed it. And the reason being is I think the global business model changed towards network effects. So when you use Metcalfe's law to value the value of a network, it's very different than using net present value and cash flows, right? We all got that wrong. The market got it right. But now we're in a situation where we've just invented cryptocurrencies, which are actually entirely driven by network models, and the key benefit that the model derives is the value of the money goes up. Okay, that's a very powerful model. But that's also happening at the same time we see massive adoption of technologies. So we're going to go from very few electric cars to, by 2030, 65% of every car in Europe being electric. We're going to see a mass change in how we generate electricity, a mass change in distributed computing power, a mass change in genetics, robotics, artificial intelligence. These are all adoption model businesses, and they're all coming at the same time in a 10-year period, which will be the fastest pace of change.
And it looks like the pandemic really triggered this, because you were waiting for a recession to happen to really go all in on crypto.
Yes, I was waiting for the macro to meet this crypto market, where it became obvious to everybody that crypto offered a big solution.
So why do you think crypto is the answer to the recession?
It's not the answer to the recession. It's the answer to the future of the financial system as a start, just as a small start, is the fact that in a debt-laden society, everybody owes everybody money. And when things go wrong, you don't know who owes what to whom. And that's what happened with Lehman Brothers and many of these other things, is we don't know who owed what, because there's daisy chains of all of this debt. Blockchain solves that. You know immediately who's the owner of the asset.
Why increase your exposure so much so that it even trumps Bitcoin?
Okay, how do you value Bitcoin and Ethereum? So we've had the stock to flow model, but really what it was to me was also a network. And you use something called Metcalfe's law to value a network. Adoption of Ethereum was much faster than that of Bitcoin at the same stage. And then you start realizing the number of things being built on it, the applications, the number of developers involved, and the speed of the increase of the number of users. So there's a lot of interconnections plus a lot of users.
I'm really interested in kind of how you're looking at all these applications that you've mentioned that are being built on ETH, DeFi, NFTs, social tokens. Are you investing in these, testing them, playing with them? What's kind of your experience with these applications been like?
So DeFi, I've invested in some of the protocols, but I have not used DeFi. I'm not really a yield guy. I don't really care about yield. I'm a more macro guys tend to be price appreciation people. So I tend to look for those opportunities more than I look for yield. Social tokens, NFTs, I've invested in some of the NFT platforms. But the social tokens, there's not many of them around, but I've invested in those two more significantly because I think they are, maybe not even for this cycle, but I think they're going to be a huge part of the global business model going forwards.
I'd love to just like hear more of your thoughts on like how, like you have this like whole framework to value ETH and Bitcoin. So like, what do you use to value social tokens?
Networks. It's all the same. Everything is the same trick.
Right.
So let's say you are Disney. How many fans does Disney have? What is their community? How does Disney access their fans right now? They have to rent them back off Facebook, YouTube, Google, Apple Music, Apple TV, Spotify. They have to rent them back and pay away economic. But what tokens do is give them direct access to those fans, because you now have a relationship where that token is the currency of the Disney world. So I can buy things, and if I happen to be a currency owner, I can get things at a discount. I can get certain access. I might get to see the film a week early. I get so many benefits that I value as a fan. And I might get Disney Plus at a discount. And if I renew my Disney Plus every year, maybe I get more tokens. And maybe I can build a business of selling Disney T-shirts and I charge them in Disney tokens and people start building businesses. So you build a whole economy around Disney, of which there is one already. It's huge, giant. But what's the difference here is, as a token holder, I now share in the economic benefits of that community. So if the community becomes more valuable, then I make more money. My token goes up. It's an asset. So culture becomes an asset that you can invest in. This is game changing. And once you think that through, you realize, okay, well, where are the big tech players in all of this? Do they understand it yet? And it's very simple. It's in front of our eyes. It's Facebook DM. They've created, not only is it a stable coin to allow global commerce on their platform of the biggest network on earth, 3.5 billion people. And if they do it, well, probably YouTube has to do it, and Spotify will do it, and Apple will do it. So it's coming. People just can't see it yet. People only look at today and say, well, NFTs are about art and social tokens are for small YouTube influencers. This is just the start of where this is going. I spend a lot of time in this space, and I'm having conversations with all sorts of people. And this is on the radar screen of every media company, every talent management business, every record label, every major brand, particularly fashion brands, that they get it. The one thing in crypto that most people don't understand, and I think it's the one thing that is going to be bigger than all the other applications. Sure, the plumbing of the financial system is big, but I think what is coming in these communities and NFTs and everything else is far bigger.
Oh, interesting. So you think community tokens, social tokens will be bigger than DeFi?
Oh, yes.
Wow. You think there's more potential there than like replacing banks?
Yes.
Why so?
Banks are one business model. This is every business model.
And talk about the environment that you're seeing now. I read something you said about the second half of this year that you expect it to be weaker than expected. A risk-off kind of a positioning, dollar up, bonds like U.S. Treasuries up. Is that like still your view? And if so, what does that mean?
Every single recession since 1962 has seen exactly the same thing. Bond yields, as soon as you come out of the recession, everyone goes, oh my God, inflation. Bond yields go up. And then what happens is the stimulus that the government and the central bank has put in during the recession starts wearing off. And bond yields fall because growth starts slowing down again. And every single time, the central bank has had to stimulate 2 or more times after the recession to find the natural rate of growth, because all this stimulus keeps coming in and then coming off. The government usually stimulates again a couple of times until the economy gets its traction. So this would be really normal. We've just had a massive spike in house prices, a massive spike in the cost of food and fuel. and all these supply disruptions. So real wages have stayed flat. Well, they've actually gone negative, but wages have stayed the same, while costs have gone up and mortgage rates went up. And usually that slows things down already. I think that we're going to see, everybody was like, no, this is going to be inflation forever, growth forever. I think, same as every time I've ever seen, it will slow down first and give us a scare. And we might even see one of the emerging markets blow up. That's usually what happens. What you should be thinking is, what was the outcome of March 2020? Massive central bank stimulus and government stimulus on a scale of which we've never seen in our lives before. So let's say there is a risk off. Okay, it's not as big as March 2020. Maybe Bitcoin goes back down, breaks a new low of this move and gets to 27,000, whatever it is. And let's say equities are down 10 or 15%. And the dollar's going higher, a lot higher. And that's making the markets feel uncomfortable. And we start to see the data slow down. What is the outcome? The outcome is exactly the same. The central bank will stimulate more. And the government will try and push through an even bigger stimulus package. What does that do for Bitcoin? Explodes it higher. So the first order effect is, oh my God, Bitcoin's going lower. But everybody should be thinking, if this happens, then this is what's going to drive it to 200,000.
Seriously? Is that kind of your target for?
Yes, my target is still remains between 200 and 400,000.
For like, in what time?
Probably the next, I think the cycle extends somewhat. So I'll give it the next 12 months.
And for ETH?
At a minimum 20,000.
Okay, so you're saying there will be a slowdown and then the stimulus will kick back in, driving riskier asset prices up. But like, where does this all end? Like this just like stimulus after stimulus and like inflating of assets. Like to me, it seems like everything is in a huge bubble: housing, equities, crypto. It's not a bubble if you look at it in the right terms. Okay. So I stumbled across this. Gold is the great price anchor, right? Everyone's used gold as a relative asset pricing forever as a system of money. Real estate versus gold is about in line. So it's kind of at fair value. Equities versus gold, pretty much at fair value. So then it makes you think, why are we thinking everything's a bubble? And then I realized what was going on is that the central bank printing was devaluing the purchasing power of fiat currency, but against these rare fixed assets. What you're seeing is all of these asset prices seem to be in a bubble and inflating, and that seems to be that way because fiat money is eroding, like it's correct depreciating.
I'm screaming from the rooftops saying, you might be cynical, you might think you don't understand it, you might think you can't afford to play in this, but you have to listen, because this is the opportunity. You can't come back to me in 10 years time and say, well, we missed all of that, all the rich people got richer. No, you, I, everybody else is saying, now is your time. Don't be irresponsible, dollar cost average, do all the right things, but here is your opportunity. This is the biggest opportunity I've ever seen, and I'm going to take advantage of it, and so should everybody else. This is not rich or poor. This is an every person opportunity, and we've never had this before, ever. That's not going to happen. And the reason being is they've discovered a magic trick, which is you keep printing money and you hide it. But what that actually does is lower the value of your purchasing power. So if you look at it in different terms, your same salary buys less of a share of the S&P 500, bar of gold, or a share of a Bitcoin than it used to before they started printing money. And every time they print money, these things keep accelerating away. What are assets? Assets are your future consumption. You store your money in an asset, and then later you sell it to allow you to spend it. That's what assets are. So you're being able to buy less future consumption, i.e. you're poorer in the future. And so that creates a big problem. The other thing is the governments have kind of bankrupt by having spent so much money trying to bail out the economy so many times that they're going to tax you more. So therefore your income's going to be less, your future's going to be less. This is not good. And they've got the risk of banks blowing up and other things, which means you could lose all of your capital. So what you've got is an asset class that's currently, just Bitcoin alone, is currently just under $1 trillion today. If we look at the size of the global equity markets, global bond markets, global real estate markets, they're all between 100 and $200 trillion. So what could Bitcoin be worth if that life raft takes us to dry land and gives you a chance? It's probably worth $100 trillion. So it's got 100x to go from here. Nobody watching this or listening to this will ever see an asset in their lives go up 100x that's already gone up 2 million%. So it's the opportunity of everybody's lifetime to actually create wealth, and it protects your wealth for the factors such as, excessive taxation, although you can't really get out of the tax system, but it gives you optionality. It also gets you out of this currency debasement cycle that we're in. If people, it hasn't dawned on people that they could have lost all of their money in the banking system in 2012 in Europe. People in Cyprus understand. I mean, all of their money was wiped out. So there's the probability of total wipeout. And we've seen it time and time again within the financial system. We've got these other risks that we don't understand, such as the debasement of money. These are risks we don't really understand. There's also confiscation risks, and we see that periodically. Basically, we're seeing it in China now. We've seen it in Russia in the past. We're all running risks. Then we've got a pension system that's underfunded. And so people don't understand that the fact that what they think is a retirement nest egg, A, is going to be worth less in real terms, and B, is not enough. And we've also got the social security or state benefit system, which is underfunded, which could bankrupt governments. We've got a lot of these big existential risks. Are we getting rewarded for them? That, I don't think we are. Ataris, the baby boomers, and they've kind of screwed it all up because they've got all the debt. They've got too much equity exposure. It's really hard for them to retire. This is why the Federal Reserve don't like equities going down, because you've got this richest group on earth who are kind of stuck. They never got enough money to retire on. But I want to look through the eyes of the millennials. So they are 32 years old. At the same age, their parents at 32, the baby boomers, had all-time cheap valuations of equities, all-time cheap bonds, all-time cheap credit, all-time cheap property. Right? So they couldn't help but make money. They kind of screwed it up because they actually ended up going into debt as well. But they couldn't help but make money. So then the millennials had the opposite. All-time record valuations of equities, all-time record valuation for bonds, all-time record credit, all-time record highs in property. So I'm like, these guys are screwed unless something else comes along. And that thing is crypto. Because the future expected return of crypto, it's been growing at 213% a year in returns. How much it makes, even though it's very volatile, sometimes it's down 70%. Over time, you're making 213% a year. It has grown as an asset, it's gone up, I think it's 2 million% since inception. No other asset in all recorded history has ever done this. And we haven't even started. I still think there's probably another 100x from here. Not even the baby boomers got given that. The S&P didn't go up 100x since 1980. So this is the magnitude of what's there. So I'm screaming from the rooftops saying, you might be cynical. You might think you don't understand it. You might think you can't afford to play in this, but you have to listen, because this is the opportunity. You can't come back to me in 10 years' time and say, well, we missed all of that. All the rich people got richer. No, you, I, everybody else is saying, now is your time. Don't be irresponsible.
dollar cost average, do all the right things, but here is your opportunity. This is the biggest opportunity I've ever seen, and I'm going to take advantage of it, and so should everybody else. This is not rich or poor. This is an every person opportunity, and we've never had this before, ever.
Also, we're in a very difficult world. Part of my exponential age thesis is the rise of technology such as AI, robotics, and all of these things. These are all going to be taking jobs away and opportunities. Salaries can't go up over time because you're competing with the machines. And if not, you're competing with somebody else elsewhere in the world. And we've got the baby boomers in the workforce at the same time as their kids, which has never happened before. So there is no salary going up. So the only way of generating wealth is to make the right investment decision, or be lucky enough to start a business, or be in a business that pays more money. So that's the magnitude of the opportunity of this life raft and what it can do for people. And that is how you have to look at these exponential assets. They're not like anything else. What's so good about them is they offer this upside that is beyond comprehension. This is why Bitcoin's gone up 2 million%. Nothing else has ever done that before. So we have a very skewed risk reward. Now, Bitcoin could go to zero every year, let's say. But on average, it goes up 213%. I mean, that's an extraordinary risk reward every single year. And that's the power of exponentiality. These exponential assets also tend to be very volatile. Look at the tech stocks. They've always been volatile. Because it's all about network adoption. Everything else is kind of noise in the middle. Once you understand network adoption is everything, and we talked about it earlier on, about this 113% growth rate, you kind of understand, and you can apply that to everything in the crypto space and in the metaverse space. You're just looking for adoption. Anybody who's trying to value stuff on cash flows or anything else is barking up the wrong tree. It's how many people are joining the network, are they using the network, and how many other applications are being built on that network. And that's what makes, whether it's Ethereum, which is a phenomenal network effect, or Minecraft. These are so valuable because everything that's being built on these networks.
But everything that we've talked about, and everybody will have, even if you're not very familiar with the space, will have heard the term DeFi or NFTs or tokens. Basically, most of that is still being built on Ethereum. And as you said, the network. So what is this Metcalfe's law that you and I have referred to? Metcalfe's law is, it really started to become understood in the 80s, and then much more so as mobile phone networks started, these giant connected networks, right? Because digital technology allowed networks to connect. Before, it's humans, we couldn't connect with each other in the same way. So networks connect with mobile phones, suddenly they explode in value. All these phone companies, huge companies. And if you added them all up around the world, they'd be worth tens of trillions probably. We just don't even think of it in those terms because they're fragmented networks. Then the internet comes along, this free network, and everybody builds on top of it, and they create network effects. Like the most classic example is Facebook. Facebook connects us with friends and family, and in exchange, they get your data, they sell you adverts, so you've got a bunch of people using it, a bunch of businesses now building on it, and this advertising monetization structure. Shareholders get rich, you and I get to fortunately meet somebody from university that we don't want to talk to, that we met 20 years ago and we're now connected with again. It's that. But the network that Ethereum and Bitcoin does is different. You're the owner of the network and the user. So as a user, like you said, with the NFT, you're actually owning a share of the network itself. So everybody uses it, owns a part of it. Therefore, if the network's going to get used a lot, you're all going to get rich. And the value of the network is going to go up massively. And the more people build interconnections, so the Metcalfe's law is not only just the number of nodes, i.e. the number of users, but how much they connect with each other. Well, you're seeing it because there's NFTs and there's DeFi and there's all of these applications, or the store of money aspect. These things all together, and then there's the linking of all of these, like Chainlink or some of these other protocols, Polkadot. They're linking all this ecosystems together. So I can send you $1 instantaneously, and we have no idea whether it went on Bitcoin rails, XRP rails, Ethereum rails, and guess what? We don't care. I promised you $1, you want to get the dollar instantaneously. That's interoperability, that's all coming. So this is what Ethereum is about. It's the magnitude of this network where everybody's developing everything on top of it. and its scarce supply. So it's seeing an even faster adoption rate than Bitcoin now, for the reasons that seem pretty clear, because it has more use cases than currently the Bitcoin blockchain does. Doesn't mean Bitcoin blockchain can't in due course, but right now there's a lot more use cases in Ethereum. Ethereum's a very different thing. It doesn't compete. That's how I like to think about it. And unfortunately, when you go online, people will tell you, well, it's competing and it's not as good. You have to ignore all of that and look at the whole space overall and just be honest, saying we don't know where this is going to be in 10 years' time. And like you say, so therefore I can own 3 of these things, and probability.
Yes, I think there's a mass scale adoption going on. So just for people to frame what's really going on here, this is the internet back in 1997 had 150 million users. It was growing at 63% a year. It was the fastest adoption of any technology the world had ever seen. We're all kind of familiar with that story. Crypto currently has 150 million users. The adoption rate is 113% a year. So it's basically twice as fast as the fastest adoption of any technology in all recorded history. So it's happening at lightning pace. Everybody is coming into the space, the institutions, the sovereign wealth funds, retail investors from ETFs, nation states, everybody. So I do think the price continues to spike significantly, not only into the year end, but probably into the first half of next year too.
Very briefly, if you've got 20p, 30p a week, how do you even buy a Bitcoin is what they probably think, part of a Bitcoin.
Well, people are making it easier now. Things like PayPal allow you to use that. So most people have a PayPal app or a Square app or one of these payment systems. Revolut in the UK is another one. You can just buy it there. That's an easy way to start. Because it's harder to set up an exchange. You could set up a brokerage account. You could do it that way too. Or you can buy, ETF. There's one launching in the UK. There's one in Germany. There's ones all around the world, Canada, the US. So there's plenty of ways to participate now, and more will come. But I do urge people to participate. Just dollar cost average, put a little bit in, don't risk too much, don't use leverage, and just participate in something that could be the biggest thing any of us have ever seen. I think right now it's a $2.5 trillion asset class. Most of the major asset classes around the world, equities, bonds, real estate, are between 150 and 350 trillion. So I think this goes to 200 trillion in the next 10 years. So that's 100x for an asset class. Mankind has never seen that before. So it's an opportunity for everybody, because everybody can own 10% of their assets in this. Everybody, the richest and the poorest.
Is it that exchange-traded funds are involved in cryptocurrency, which was seen by idealists as breaking the power of central banks, given that they're betting on the future price? You might have to explain. I mean, what are they exactly doing?
It's a bit complicated. At top level, I don't mind. It's adoption. It's still adoption. It's not in the way that the idealist would believe, which is not your keys, not your coins. I store them yourself, much like you do with gold bars. But it allows people access to this revolutionary technology and the returns that can come from it. The problem is it was done suboptimally. It was actually benchmarked against a futures contract. So a futures contract is something that is about the future price of an asset, and it doesn't have to stay in line with the actual price of Bitcoin. And what happens is when you get a lot of demand for the futures contracts, it trades at a huge premium, which means that you're actually lowering your return. So a lot of people are going to come here and see, oh, well, Bitcoin was up 100% in the last quarter, and they'll suddenly see that they made 30%. It's the same with the USO oil ETF. It's based on a futures contract. So it doesn't actually represent the underlying. So people, even the SEC is saying they're trying to help people here. They're actually not. They're actually doing the opposite. They're exposing them to a risk that they don't understand, which is the premium and discount that futures contracts can trade at.
Gary Gensler, who runs it, has warned that crypto is like the Wild West. I mean, unwittingly, that may attract people in Middle America to it, but there's something political here about statements coming from him and others warning people against spot trading, clearly, or spot investments that you can do on the internet easily?
Part of it is he's in his own political battle to who regulates this. So what he's doing is shaking the saber, saying, somebody needs to regulate this and it's going to be me. At the same time, the CFTC are trying to do the same. The Fed are looking at other ways of regulating, the OCC. So all of these agencies are fighting who's going to regulate it. Why? Because they know it's big and it's power. So whoever gets it gets all the power. So I think that's fair. I think they're also looking at this with the eyes of a 1934 securities law, which is nonsense. What this really is real-time venture capitalism for the everyday person. The everyday person has been shut out of the big opportunities because you have to be accredited. You need to go through a financial institution. There's barrier after barrier after barrier. So only the rich people get access. This is what has to change within this. This is allowing, if you don't deal with them as securities, you're going to allow everybody to be able to participate in this kind of early stage VC where the big gains are. I think there's a big battle that's being drawn up. He is showing the hard line because that's how you negotiate. All trade negotiators, everybody does the same thing. No, never going to happen. Obviously, what happens is they reach a grand compromise. There's too much money in this space, too many young voters in this, too much innovation in this space for him to come down and say, we're gonna prosecute all of these tokens as securities. Everyone's going to prison. It's just never going to happen. It's setting the battlegrounds for the fight that has to happen. You know, you can't have one nation state saying who is a good actor and bad actor. It's okay if all nations come together and say, we've made an agreement that somebody's a bad actor. That's okay. At least it's some consensus. But for the United States that owns SWIFT to say, no, you bad, you good, people don't want that. China doesn't want it. That's why China's building out its own central bank digital currency rails. In fact, the Europeans don't want it. They're building out their digital currency rails. So are the Singaporeans, and so are the Swedes, so are the Danes. In fact, everybody is. So we're moving away from a SWIFT world, whether they like it or not. In this world of free capital flows, whoever accepts that crypto is a core part, and Singapore's done a great job with that, and I think the Middle East will do a similar job, we will see capital flows to them and away from places that don't give it a good home. So I think it actually works well because it actually changes the entire narrative around how rules-based global order system works.
Not only are ordinary people not allowed to, or not being able to get into this market for so many decades, they've had to see their own currencies get more and more devalued. We know here that the standard of living is set to decrease, according to many analysts. Could the very same vested interests in NATO nations not deliberately sabotage crypto by quantitatively easing, but to buy the market, buy the crypto market, just as they've owned the currencies, fiat currencies?
They will buy crypto assets over time. That is going to happen. Are they going to be a large enough participant because they've come in so late to be able to manipulate that market or dampen the market like people say that happens with the gold market? I doubt it, because something is unique. This is a distributed network of owners around the world from 150 million people that will soon be 1 billion people. So their ability to control it is almost zero. It's a fascinating space. It is really anti-establishment at its core and creates a new world based around kind of distributed ownership and proven ownership of assets that people can't mess.
What the hell is happening with the market right on this last month?
Yeah, I mean, it took me by surprise. It's scary because you don't feel in control. I think we're probably, because of the new entrants into the market, so downside will be less big in the major cryptos. It'll still be huge in the more risky stuff. This being a $250 trillion asset class, which is 100x from here, which would be the largest growth of any asset class in all history in a short period of time.
So what the hell is happening with the market right on this last month?
Yeah, I mean, it took me by surprise. My base case was that we were going to see the typical year-end rally. Obviously, most of us had the same idea. Usually when most of us have the same idea, it doesn't work. But the other thing I did know is, having come from that finance background, knowing how hedge funds and institutions work, I also knew that if you're a hedge fund and you've got crypto in your portfolio, you've probably had a good year. So to get paid you tend to close out your portfolio. You know what you're going to get paid at the end of the year. They are incentivized to sell their positions, to go away for Christmas, have a break, that kind of stuff. The institutions like pension funds and others, they tend to rebalance their portfolio. So like Ethereum's up 500% this year. So if they started with a 1% weighting, they're now at a 5% weighting. So they'll probably bring it back down to, let's say, a 2% weighting in line with their allocation. So you've got institutional sellers that never really were in the market before. And they're not expressing, I don't think, a negative view of the market. What they're just doing is rebalancing for year end. And so my general view is that most of that selling is now done. And so the next thing they all come into January with is a new P&L. That's right. And there's nothing wrong with somebody focusing their attention on one particular area of this new revolution, blockchain revolution, digital assets. But it doesn't have to be at detriment of everything else. That's crazy. It's not a zero-sum game. If we don't create sound money first, it's all lost. Okay, that's his opinion, and good for it, Jack. Go for it. Get people around you, build stuff, do stuff. But don't take away from other people doing other things in the digital asset space, because there are other people who are focused on specific things in DeFi or stablecoin, interoperability, and they're all equally applicable. Let everybody focus on their bit. That's how distributed networks work. If we all focus on our bit, we've got a massive network of experts all focused on building out component parts of all of this. Because everybody fears change, right? That's just a human thing. And the rate of change here is extremely fast. All of these things is people fearing change. You know, Jack Dorsey's like, well, I don't want this Web3 thing. I just want Bitcoin. And, you know, the Ethereum guys are like, we don't want Solana and Terra and Avalanche. Everybody fears change. You know, traditional media fears change. The banking industry fears change. When change is happening so fast and it's not being driven by one entity, it's this broadly spread phenomena, it's scary because you don't feel in control. The idea is, without going into the 2 hours of history and everything within this, monetary system and system of value is broken. The ownership and the monopolies that control a lot of this are something that most people have become uncomfortable with. And here we have a new world, this digital world that is distributed, that has less intermediary. And it's a world where we can create endless GDP because you're not constrained by natural resources. In Brazil, what is the largest driver of natural resources? Agriculture and energy. That is a constraint on the GDP of the country. So the amount of money sloshing around, the amount of opportunity as you guys as entrepreneurs is actually a direct correlation to how fast GDP can grow. And you've got other monetary issues. You know, Brazil has always had a relative level of instability with its currency and other issues. So here we go in a new digital world where you can create digital sovereign states of which you can operate in as a Brazilian that has nothing to do with the Brazilian economy. And it's limitless. There's no boundary. That's why it becomes the new universe. Here we are walking away from an old broken system, which is Brazil 1.0. And here you are walking into world 2.0. You're not constrained as a Brazilian. I'm not constrained because I'm in the Cayman Islands. So we can build businesses like you guys are, which exist everywhere. And again, you know, we're showing that here today. Well, I'm in the Cayman Islands, you're in Brazil. We're doing this in English. It'll be translated into Portuguese. And what we're doing is creating a globalized piece of content. I mean, it's really interesting. Those things were not easy to do before. Now it's almost frictionless. The fact that we're in different countries is frictionless. We have no issues whatsoever. What we'll find is that over time, volatility falls as more people are in the network because you don't have discrepancies between buyers and sellers that create illiquidity because there's more people in the network. So you'll tend to find, I mean, Amazon now is trading off call it a 30% volatility. So it's half that of Bitcoin. So I think, you know, as Bitcoin or cryptocurrencies get to 1 billion users plus, what we'll find is that the volatility will fall. The prices become less exponential in nature, both to the upside and the downside. Well, 1 billion people, bizarrely, because of the compounding numbers, if it's growing 113% a year, you get there by 2024. Just use the adoption curve. Assume it slows a bit because adoption always slows because the rate of change goes down when more people are in it, right? So it's easier to go from 1 person to 2 people, that's 100% growth, than from 2 to 4. Just extrapolating the numbers, you get to 1 billion people by 2024. And that's by slowing the rate of growth down to 80%. And so you're at 3 billion, 3.5 billion by 2030. Well, and also look at the holders of crypto. They're not the traditional holders of equities. Here's a bunch of old people wagging their fingers saying, well, it's much more volatile. The younger people who own crypto like the volatility because the volatility gives return, risk reward. while the equity market gives less of that. So it's a whole change in risk appetite for the population. So it's currently about 2.5 trillion. If I look at all the other asset classes around the world, if I look at the total derivative market, it's 1 quadrillion. I think there's a reasonable chance of this being a $250 trillion asset class, which is 100x from here, which would be the largest growth of any asset class in all history in the shortest period of time. That will pretty much dovetail in with the idea that 3.5 billion people are using it. That's just extrapolating the growth numbers of the network. So if 3.5 billion users in 2030, well, the market cap's going to be something like 250 trillion. Yeah, it all kind of backs out pretty straightforward just using the network adoption model.
When regulations come, do you believe the market will crash? And if yes, do you think there will be a fast recovery or will be a slow recovery?
I think we're probably, because of the new entrants into the market, the downside will be less big in the major cryptos. It'll still be huge in the more risky stuff. And I don't know the format of where we go, whether we keep going that log trend and we keep hitting the bottom of it in a sharp sell-off like we did this year, down 50%, then back up again, or whether we do a down 50, down 40 and trend sideways for a year. I think we'll see both of those types of price actions, but I don't think we get the down 80, 90. I don't think that's applicable in the market as deep as this now. It's ridiculous. So they're two different things. I think the application growth of the network of Ethereum currently miles larger than Bitcoin, and therefore ETH is still undervalued versus Bitcoin. But ETH will lose market share to others, and it's the whole space will go up 100x, and nobody should care what's the largest thing here. It's the whole space we're interested in. Ethereum is a richer, deeper environment with more participants in the network. So it's going to be slightly more resilient at this point. Exactly.